This is Covered Calls with Kevin Simpson, featuring expert insights and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
Welcome to this edition of our Covered Calls podcast. My name is Kevin Simpson, and today I'm so excited to have Bradley Barrie joining us. Brad is the co-founder and chief investment officer of Dynamic Wealth Solutions. And Brad and I had an opportunity to meet through Amplify Investments when we were talking about Devo, the ETF, and I was just fascinated by Brad's story and asked him to come on the podcast. Before we get into your background and what you do at the firm, I wanted to dive right in, Brad, and talk a little bit about markets and more specifically the labor market and kind of how that will play into 2024. This week, we saw a big layoff at Spotify where they said they were going to lay off 17% of their workforce. And this seems like yet just another tech company having a big cost-cutting, a big emphasis on cost-cutting specifically within their workforce. And I'm just wondering what you think in respect to the labor market, how that could affect the stock market moving forward, the economy moving forward, and then most specifically the Fed's decision moving forward. I know there's a lot to unpack there, but diving right into it is how we do it here.
Yeah, absolutely. I'm excited, and thanks for inviting me. I'm looking forward to this. We certainly live in interesting times, right? It seems like these days bad news is good news, right? Where job growth is slowing down, and there's not as many jobs being posted, and is that considered good news now? And we digest a lot of information in our firm and in my role in helping advisors. And what I continuously have heard is inflation, right? We have to get inflation down, and inflation's coming down. So the market likes that. So it's going up. And in the back of my head, I always think and wonder, why is inflation coming down? And if inflation's coming down because the economy is slowing, which is what the Fed wants, it's good for inflation, but what is it for the economy, right? And I do wonder if in the future, people won't be focusing on inflation as much of an issue, and then people will be doing the age-old, be careful what you ask for, you just might get it, right? It's people wanted lower inflation, well, we got it, but nobody asked how do we get it? And if we get it by having a much slower economy, are we going to have the inevitable soft landing? Is it going to be a hard landing? Is it going to be a landing at all? Again, there's so many aspects. One of our core philosophies in what we do is preparation over prediction, right? We all love to talk about the future and try to predict what's going to happen. And if we do our job correctly, and investors and advisors are appropriately diversified, then they're prepared to some degree, regardless of what happens, right? Versus if we try to predict and say exactly what's going to happen, look, I have no clue what's going to happen. I have opinions, and I've watched amazing people like yourselves on the television and other channels and digest all those opinions. But there's no perfect crystal ball. It's interesting times when the bad news is good news.
Well, then let's get into that. I was going to save it for later and talk a little macro first, but since you brought it up, with correlations so high between so many different asset classes, your firm takes a different approach when looking at diversification and building portfolios. How is it at Dynamic Wealth Solutions that you approach asset allocation, diversification, and how do you assist financial advisors in that capacity?
Yeah, so just a slight correction, we're Dynamic Wealth Group, and Dynamic Alpha Solutions is our OCIO firm. So we do get a little confused with our name, so I apologize on that. But we help advisors through Dynamic Alpha Solutions build truly diversified models and asset allocations. It's funny, I started in the business 26 years ago, give or take, right out of college. And if you look, Morningstar style boxes are over 30 years old. Those quadrants of the style boxes, right? The 3x3 style boxes over 30 years old. And And when I started, I was taught, pick the best large cap growth manager, pick the best small cap value manager. And my goodness, stay away from any managers that have style drift. Style drift is evil. Stay away from style drift. That's kind of how the industry taught advisors back then. And even back then, I would scratch my head and say, well, geez, I'm just some, snot-nosed kid fresh out of college. What do I know? Shouldn't the portfolio manager, shouldn't somebody like Kevin Simpson know better whether they want to be large or mid or small or whatever? So many times when I was an advisor, I would look for style drift. Actually, I wanted managers that had flexibility to be able to say, no, we like small cap now, we like mid cap now, we don't like anything now, so we're actually going to build some cash, or be selective in how we do things. So our overarching model, we call it multi-dimensional investing. We don't live in a two-dimensional world. We live in a some would argue 3+ dimensionals, but we're not in a physics podcast. So we'll keep it simple, 3-dimensional world. And we think investments should be multidimensional as well. It's not just about stocks and bonds. And we try to diversify asset classes, but also diversify with strategies and approaches, right? We have our buy and hold approach, but we have a tactical approach where we look for managers that can be tactical. And then we look for managers and strategies that are alternatives. And they might be, we look for the alternatives to alternatives, because alternatives means a whole nother world, right? And to us, it's not just gold and real estate and commodities. It can be, again, different approaches and what have you. So, happy to kind of dive into more of those, kind of as we chat.
Well, you brought up physics. Physics never lies. So I'm a big fan, but we'll bore our viewers because we have a financial advisor community that primarily watches the show, and I have a feeling if I bring in any type of science conversation, we'll lose a good deal of our audience. And quite frankly,
Sure.
If I was watching, might lose me too. Although I think the more we try to bring the mindset of a rules-based approach to investing is something maybe we borrowed from the sciences, and I think that lends itself really well to successful asset allocation. As a PM, style drift is something that we try to stay away from because we have this very, very unique defined little space in which we live in with respect to our covered call approach. So one thing that I always pride myself on is that I know a whole lot about one really uniquely particular area of investing, and anything else you've got to find the professionals that know what to do. And that's what makes even when we were first talking, that's what made me so fascinated by the way you look and build models and help financial advisors, because it is that unstructured approach to asset allocation and diversification that it allowed me to enjoy our conversation so much. So if you want to pick up on that, just to talk a little bit more about your approach to it, your firm, because we do focus primarily on this podcast, not that other viewers aren't welcome, but mostly we're talking to the financial advisor community. So if you could just continue along that path and elaborate a little bit more, I think it'll be tremendously helpful, because I found it so interesting.
Sure. I mean, we can go all the way back to Harry Markowitz, right? And what is asset allocation? What is diversification supposed to be? And many times I hear the misquote on what Harry Markowitz proposed, right? And people tend to think that he talked about diversifying your assets and asset classes, and that's really not the premise. The premise was to diversify the risks of your asset and asset classes, right? Diversifying risk, not necessarily asset classes. And I have slides that I've shown advisors, and when I was an advisor myself, many times I would propose a portfolio and I would show them this nice pie graph that maybe had some large cap, mid cap, small cap, international, different bonds, different funds, and the pie graph inevitably would be many different colors. And when I was in private practice, I had wonderful clients out in the Midwest area, and a lot of my older clients would look at that and say, "Oh, Brad, look at all the pretty colors." And that's what they saw. All the pretty little colors represented all the diversification. And sadly, if you dive dive deep and you look at the correlation that you alluded to earlier, the correlation between most stocks is very high. And even the correlation of bonds to stocks, especially during times of stress like last year, tend to get very correlated. And, we're believers in diversifying the risk. So a strategy that can be tactical, a strategy that is, global macro long short, that invests in stuff that is totally not related to stocks and bonds, has that non-correlation. So we look for something, we like to call it the causation for the non-correlation, right? It's don't just look for non-correlation, because maybe it's non-correlated by happenstance, and during times of stress, it will become correlated. So we look for strategies that are non-correlated with the cause, that have a logic to them. And, it's again, our matrix is very simple. One of our core philosophies is to simplify the complexity for advisors, so that
I like that.
They can
just speak in my language.
Yeah, we believe advisors. It's funny. Again, I'm a CFP. I sat across the table from individual clients for 20 years and did amazing financial planning and solved a lot of goals for people and helped them to achieve their goals. And I think the financial advisor profession is one of the best professions to have an impact on people's lives, which is why I became a financial advisor. My original degree is in mathematics. So, when you talk about science, I certainly understand math. And you say science can't lie, but there's the old Mark Twain quote about statistics, and says there's 3 types of lies, damned lies, and statistics. And
I said physics, not statistics.
I know. But yeah, my background is in math, and I understand math and understand why sometimes it can be confusing for folks. So that's why, again, our core philosophy is to simplify the complexity. We don't eliminate the complexity. We don't dumb it down and ignore the complex world that we're in. We jump in the deep end for the advisors, scour the investment universe so that they don't have to do all the due diligence on all the investments, to make sure we're finding investments that are of high quality. And different than I think a lot of firms, where we're not a pure quant shop, in the asset allocation models we build. We certainly look at the quant aspect of all the strategies that we pick. We look at the Sharpe, the standard deviation, those types of statistics. But there's a drum I beat many times in this industry on risk and measuring risk, because standard deviation is generally the measure of risk in our industry. And I'm not a fan of that, because again, my math background teaches me that standard deviation is how much do you deviate from the average, right? Both on the up and the down. And in 20 years of working with individual clients, I never once met a client that didn't want deviation on the upside, right? It's kind of silly, but why are we trying to minimize total standard deviation when really what we want to minimize is the loss deviation, right? So if there's one takeaway advisors have from this, it's standard deviation is not what your clients view as risk. It's loss deviation. Break that standard deviation down between gain and loss deviation. That's something we do for our clients and in all the analysis that we do, which is one reason we prefer the Sortino ratio to the Sharpe ratio, to just get a better measure of risk-adjusted performance from that standpoint. And we also look at not just trailing data. We don't just say, oh, this guy has a 10-year average, or this manager, this fund is a great 5-year average. That's one point in time over the last 5 or 10 years. We look at all the rolling data. So we'll look at a 3-year rolling return, 3-year rolling Sortino, 3-year rolling loss deviation, dive deep into the quant analysis of different strategies. But look, if it was as simple as, oh, it's a 5-star fund and it ticks all these boxes, it's going to be a great strategy, our job would be easy, right? A quant algo would replace us, which some firms have tried to do. But we include a qualitative measure to all of our analysis. So the first time you and I met, Kevin, we were doing due diligence on Devo. And we talked about how it met all our quant screens, and we were big fans of it, but we wanted to get to know you. We wanted to get to know the approach. We wanted to get to know the strategy. So, not to the degree that we'd be able to replicate it or be as good as you, but we want to understand how it's being made, right? there's an analogy I use quite a bit. Sometimes so much my other teammates get sick of me talking about it, but it's my cookie analogy. And we have a blog on our website that has a lot of my thoughts on it, and the cookie analogy is on there. And I think investing is like baking cookies, right? You have to, in order to bake cookies, you first have to get the best ingredients out there, right? You gotta find, the highest quality, and hopefully that's what you do, is you find the highest quality ingredients out there. But then the second step is you have to get a great recipe, right? And you want to make sure the recipe. Yeah, and that's our qualitative things. Like, what's your recipe? We want to get to know that, and then we want to get to know the chef. You're the chef, the baker behind it, putting the recipe and the ingredients into the cookie, right? And that's part of our analysis. And to finish that analogy, the key to making great cookies is also to leave it bake long enough in the oven, right? Investors have a bad habit of investing, and it's been a month and I've not made money. It's been 3 months, and sometimes advisors, let's be honest, advisors have that downside too. And you got to let the cookie in the oven long enough. So again, that's what we help advisors try to dive deep into it. We do all the analysis. We pick the ingredients. We pick the chefs. And our overall asset allocation is also like the cookie analogy, because if you try to build an asset allocation and you only use a few ingredients, it's like baking a cookie with only sugar and chocolate chips. And if you miss the flour, or we always talk about the secret ingredient people don't think about in cookies, and that's the salt. If you don't put salt inside a cookie recipe, it doesn't taste good. But if you just eat salt by itself, it's not good, right? So salt is sometimes the non-correlation, right? It's that non-correlated ingredient you have to add to the recipe in order to get the end result that you want. So
yeah, you delivered that perfectly. And tell your team that you can't get enough of that, because I think it really illustrates and articulates what you're doing. And even using that same messaging to clients, I think, can be super helpful, because you talked earlier about no one wants limited upside. You just want unlimited upside with zero downside, and maybe a 10% return of just free cash flow in the interim. But I have a friend, Nick, who always says that clients never really think about risk, or they would be calling up and complaining to their financial advisors, why did I make so much money last month? It's only when you find the downside capture and the exposure to loss that you really think about risk. And standard deviation is also somewhat limited in its inputs. We had 12 years of a near zero interest rate environment. It creates a little bit of an unusual, perhaps skewed measure of risk. So I like the way you explain that, and it's as it led into the cookie analogy. I wasn't 100% sure where you were going with it, but you stuck the landing. Thought it was really good. Good. Yeah, I'm big believer. Again, I sat across the table from investors. It's my degrees in mathematics. I originally wanted to be a high school math teacher. That's what I originally went to college for, and I have the utmost respect for teachers and what they do. And when I became a financial advisor, it afforded me the ability to kind of teach my clients about wealth and money. And look, investing can be scary, to the layperson, and putting it in words in context that they can relate to, I think, is very helpful to retail investors. So again, another tidbit for advisors is to try to tell the stories, use analogies, relate to individuals. I'll share with you, a few months ago, I did a presentation to a group of individuals. Actually, normally we present to financial advisors, but we actually presented to a group of individual investors, of all places, at the Star Trek convention here in the Las Vegas area. And a little known fact on our team is the majority of us are big Star Trek fans. And there's the homage to our scouring the investment universe that I mentioned earlier, right? But we had the opportunity to present, and we presented on what Star Trek can teach you about investing, and just analogies, parables between, you have shields around the ship to protect the ship, right? You need to have shields around your portfolio. You need to manage risk, right? And the goal of investing
should not be to beat the S&P 500 every year. That should not be an investor's goal or an advisor's goal, right? To put it in the Star Trek terminology, the goal should be to live long and prosper, right? And that's what everyone's goal should be. So we it was a fun little thing we did with my business partner David, who's also a big Star Trek fan, and we've attended the convention many years, never got to stand on the big stage and present, but it's all about putting it in terms people can relate to and understand to. You bring down the scariness of the investment barriers. And when you do that, investors are so much more receptive, and they're so much more, just great client relationships, which is what I think everyone wants.
Did you watch the last episode or the last season of Picard?
I did, yes.
I thought they tied
Yes.
an amazing bow on the franchise.
I
that version of the franchise.
Yeah, they brought back the whole crew, and it's just great story. And those actors are such wonderful people too. It's being at those conventions. Sometimes people will ask me, Brad, what do you do at the Star Trek convention? You're there for like 5 days. I mean, geez, what do you do? You got to be bored. And it's like, no, it's the thing I enjoy most about those conventions is you get people from all over the world, literally from Sweden and Japan and all parts of the United States, from all over the world gets together. Everyone puts their differences aside and everyone gets together and has fun, right? It's
the United Federation of Planets. Yeah, of course.
It is. It's a microcosm of what we want the world to be, of looking at what do we all have in common and not what do we have in differences. And it's such wonderful people, and the actors, are such wonderful people, and they spend time chatting and, meeting people and autographs and pictures and what have you. And, but yeah, that franchise of Star Trek has gone on for over 50 years. It's kind of amazing what Gene Roddenberry was able to create, and the revival of it. I mean, there's 3 or 4 shows currently on. I mean, there's cartoons and New Generations, and the Picard with the Next Generation and what have you. So we digress a little bit. So hopefully the non-Trekkie fans won't.
That's what we do here. It's humanizing the conversation. But yes, I've always loved those stories, and I thought that Picard season was just such a neat homage to one of the series that I was growing up with. But we digress. We have limited time, and I do want to mention one other thing that you do for financial advisors in the OCIO capacity. So if in a pretty short answer, if you could just tell advisors how you're able to help, but maybe even what an OCIO is just quickly, and then how you can help, and where we can learn more about the dynamic wealth solution team, the whole, all the different variations of it.
Yeah, absolutely. So the best place to find us is the dynamicwg.com. That's our website, dynamicwg.com. It's the shortest URL that we have. We work on a partnership relationship with our advisory firms. It's not a newsletter service where you hire us and we send you our models and it's take it or leave it. It's not what we do. We really get in the trenches with our advisory teams, create customized solutions for them based on our philosophy. We get them to understand our philosophy, help them communicate it. They can white label it for their clients. That's fine. It's really we want to help advisors look amazing in front of their clients. And our website, dynamicwg.com, is the parent website, and there's two sides to it: the Dynamic Alpha Solutions, which is the OCIO, which is an outsourced chief investment officer. In that term, there's a lot of different types of OCIOs in this industry. We really try to be the partner to our advisory firms. We don't want to work with 100 different teams. It's really a small segment of teams. We come from a unique aspect because many of us were financial advisors. Again, I've given you my background. I've sat across the table. We know what you go through. So we try to help you be better at that. The other division of what we do, we recently launched our own mutual fund. So on August 1st, we launched a mutual fund, Dynamic Alpha Macro Fund. That's also on our main site.
Can you give the symbol, Brad?
Yeah, symbol is DYMIX, Dimix, DYMIX. It is a innovative fund that is includes alternatives. So it's the same philosophy that we implement with our models, our OCIO models, except it hones in on alternatives. So it takes that non-correlated alternative aspect and marries it with a long-only U.S. equities, and the two components are weighted about 50-50. And because they're non-correlation, when one is zigging, the other one might be zagging. And then because it's in one fund, we're able to actively rebalance. So that's why it's called in our firm is dynamic alpha, because we believe when you have non-correlated assets, you can benefit from rebalancing. We do it for you in the mutual fund because it allows for faster, easier, cheaper rebalancing. And our non-correlated asset is a fundamentally managed global macro long-short strategy implementing futures. And that's a mouthful there. What the heck does that mean? And, if there's time, we can dive deep into it. But it's unique in this industry. In most other future strategies or managed futures are trend following algorithms. And that's just not what we are. It's a pure fundamental strategy managed by a team of economists that we work with, and they make fundamental calls. So they'll go long or short different futures markets that are totally non-correlated. And again, if there's time, I can give you some examples. But we're very proud, ecstatic of that, and it's different being on that side of the table. From recommending mutual funds for 20 years to investors to now actually being on the portfolio management side. So I have even utmost more respect for you and what you do. And you do it on the ETF side. We do it on the mutual fund side. And it's a good profession. And yeah, we help a lot of folks. So.
Well, congratulations on the launch of the new fund. I know how awesome and exciting that is. And that to your point, that's why I like you so much. You're out there servicing the financial advisor, doing everything you can to help them service their mutual clients, and it's a very, very noble profession, and one that we both take great pride in. We are up against it as far as the time is concerned, but I know that our viewers would love to hear more about the deep dive into long short managed futures. I'm kidding. That's why I hire professionals to help get into the weeds with certain things. But I think today's conversation was excellent. I hope that people will reach out to you to learn more about the fund, the OCIO services, as well as the asset allocation models that you can help advisors with, because as I get to know you more and more, I think it's just an incredible tool, resource, and it allows financial advisors to be better at their craft. So thank you so much for joining us today, and we look forward to continued friendship and hope to have you on the show again.
Well, thank you, Kevin. I appreciate it. It's been a joy, and I thank all the advisors for all the hard work they do and the excellent service they give their investors and clients.
Thanks, Brad.
This message does not constitute an offer to sell or a solicitation of an offer to purchase securities through CWP Advisory Services. Investments are not guaranteed and involves risk of loss. The views and opinions expressed in this message are those of investment professionals made at the time this content was recorded, are not necessarily the views and opinions of CWP, and may change in time without notification. For additional information about CWP, visit CWP's or the SEC's website for a copy of our ADV disclosure brochure and Form CRS.